Hi, I'm Elizabeth Karp, Forensic Manager at IAG Forensics and Valuation. Welcome to another session of Behind the Numbers. Today, I'll be talking about what a K-1 is and who receives it. A business, financial entity, or an S corporation issues a K-1 to each interest holder to provide information about their share of the income or losses and dividends. Beneficiaries of trust and estates may also receive a K-1 reporting their share of income and distributions. The recipient of the K-1 then reports that information on their personal tax return. Schedule K-1 is typically issued by pass-through entities, meaning entities that don't pay corporate tax on their income, but instead shift the tax liability to their interest holders. Because the entity pays no taxes and passes them on to the stakeholder, the K-1 provides all of the information that is needed to file their taxes and accurately report the income or losses. The K-1 form used by partnerships, S corporations, and trusts vary slightly, however, they look very similar. Part 1 of the form will identify the issuing entity, whether it's a partnership, corporation, or a trust. In Part 2, the recipient is identified along with their ownership interests. So you'll likely be able to determine the name, the address, the percentage ownership, and capital account details if applicable. Part 3 of the form relates to the stakeholder's specific share of the income or losses, credits, deductions, and distributions. A lot of useful information can be found in Part 3, but you may need to reference the IRS instructions to understand all of the 20+ boxes on the form. This is Elizabeth Karp with another installment of The Truth Behind the Numbers.